Hey, good afternoon, everyone. Marty Mazur here, Friday, 7th of October, 2022, with just a quick market snapshot for you. I thought I was going to just add this to the tail end of the economic update, but today has been so volatile to the downside that I thought I'd just pop in. I'm sure you'll get this after the close, but it's 12:33 Pacific time, so a half hour before the close as I speak to you. So in front of you is the 60-minute chart. I thought we'd start there for this one. And recall right at the end of the last video, we were breaking down here. I was pointing to these gaps, that could get filled, and you can see it pretty much gapped back down with little trouble here. And then broke through there. And I said that right there at the end, I said that if we get a strong jobs number and the Fed does not relent on this very hawkish talk, it would not surprise me in the least to see us give back all that we made those first two wild to the upside days to begin the week this week and to begin the quarter even. And we got to be pretty close to there. I think we might still be up just a little bit, but literally as I speak, the S&P is down 3.28%, NASDAQ's down 4.25%. So big down day. Now, I keep introducing and discussing some of the under the surface dynamics, because we can take situations like this and we can just think, oh my gosh, everybody's panicking, everybody's running to the fences, and so on and so forth. We know there's been a lot of panic or a lot of pessimism in the market already, some real weak sentiment readings. That's why in last weekend's video, we kind of pointed to the prospects for a big bear market bounce, and we got a really big two-day bounce. I think it was over 5%, which is historic. But boy, did we give all that back. And we had a jobs number today that I don't know that I would say is strong. The trend over the last few months has been actually trending lower in terms of new jobs, but certainly nothing recessionary. It really emboldens the Fed to say, listen, the economy is okay, certainly at the labor market end, and we can continue to talk tough and be tough into next year. So that all suggests something not so good for the for the bulls, and it's counterintuitive. I know a lot of people push back against this because, well, how could weak jobs news be good for the market? Well, right now the market's trading on the Fed and on prospects for inflation and more Fed tightening going forward. So anything that's positive suggests that the Fed can keep going with that. Anything that would be negative would spark a rally. So if we had a weak jobs number or more Fed members were talking about credit risk in the system, would have had a huge rally. Now, aside from that, there's those underlying kind of positional things that I keep talking about. And a really biggie in this market is the options positioning among dealers. So here's the morning note from the folks who we subscribe to their stuff or we pay to give us the insight into kind of this positioning below. So here's part of their morning note. Volatility certainly works in both ways. However, below the 3,700, the strikes really contain only put options. As the market moves lower, the negative gamma feedback loop spools up, dealers short to hedge. I've talked about this many times lately, which pushes the market lower, requiring dealers, those who sell them the hedges, to short more. They have to protect their positions because they're losing money to the downside. This implies that a break of 3,700 invokes a test of what they call their put wall, this concentration there at 3,600. And as I talk to you, we're at 3,625. It's not in place to the upside because over 3,800, you just don't have that offside gamma that would suggest, you're going to get some big move because of that. But that's only as we sit here today. I've actually seen these things change intraday in terms of positioning to where suddenly you get a move and then suddenly you get dealers covering positions or having to buy positions to hedge if the market were to run against their positions to the upside. So that's why they're saying here it works in both directions, or it works both ways. So folks, understand that when we break through these levels and this huge put exposure that's out there has to be hedged on the part of the people who sold the puts, you're gonna get some big stuff, in this case to the downside. So I think that has a not small amount to do with what's going on today. So that's not fundamental. It could certainly in a reflexive way create even more pain in the market as retail investors give up the ghost because they can't take the pain any longer. And then that impacts the economy. It's a tightening of conditions when financial markets fall apart. So it can ultimately get there. But as we sit here today, a not small amount of this, I'm certain, has to do with this hedging. If the market would have gone the other direction, if, for example, we came in with a negative jobs number at the extreme, oh my goodness, you would have seen something to the other extreme. And then I'd be telling you, like I have on some big updates, folks, this is either a big short covering rally and dealer hedging and this sort of thing, because there's still quite a bit of short interest in this market. So this kind of move, these 3-4% moves, very unusual in the long-term scheme of things, but not that unusual during bear markets. So I'll keep you posted, but just want to continue to throw that out there and let you know that all may not be as you might think it is on the surface. Okay, so on that hourly chart, here we are coming down. This is a delayed chart, about to test these levels. Not quite there yet. S&P's come off a little bit of that. It's up a few points from what I just mentioned. You rolled over here. Remember, I pointed up in here where we were kind of consolidating, but we were getting some rollover here. I said nothing looks too good to me on the hourly chart. Might get a little bit oversold. It's going to be a very headline, data-driven market the next few days. I can tell you right now, the CPI number next Thursday is likely a bigger deal than the jobs number was today. How we trade into that and this positioning among options dealers, all that stuff will influence the action that day. But if you get a real hot CPI number, you could see more of this. If it comes in weak, could have a big rally, particularly off of heavily shorted positions in the market, which I suspect is how we're going to go into next week. And then on your 1 year daily chart, so we had our bear flag here on the daily, played out to a T, right? You move that down, takes us right here. So now look what we have here, folks. We have another one. I think I pointed this out to you last one, and I said we break down through there, and all you're going to see on technical analyst screens is going to be bear flags. And sure enough, we broke down there. That would be your sell signal. Your price target would be the length of the flagpole from here, right? So that would take us down a ways. We'll see. We'll see if the market doesn't find some support. I'll say it again. We're entering into the best quarter of the year typically. Hugely bearish sentiment. A lot of short positioning in the market. Today played out the way I suggested if we would get a strong jobs number, and that's how that one was interpreted. Let's go ahead and check out the weekly chart. And so we are pretty much at that right now, that 200-week moving average, which outside of recessions, when we had these patterns that we drew over a 30-year time horizon, historically, for what it's worth, could be very different this time. That's the spot where bottom. You can see this week it's bouncing up there. Still a little green on the week, so we may escape with a gain. We do. On the RSI, we have a legitimate positive divergence, right? You have your lower low on the price, but you have a higher low there. Really want to see this curl back up and get your buy signal here before you say you've got a legitimate positive divergence there. And then you'd have your short-term downtrend line right here that you would need to break out of if you're a trader, at least on the weekly, to validate your buy signal. And then, by the way, folks, these downward wedges, I think I've done this with you before. What a technician would do is they would take the width, the width at the widest part of the wedge, and then as you break out, that presents your upside target. So, folks, I think I'll just stop there. I think that's enough for the moment. Pretty much expressed what I wanted to. I want you to be cognizant of the fact there's some underlying forces that just have to do with hedging and protecting both the hedger and the dealer who facilitates the hedges. They both have their situations to deal with, and the dealers have tremendous exposure right now because there's a ton of puts, as our friends at Spot Gamma have mentioned, and that adds for some real risk to the downside. If we break through certain level, broke through that certain level here at the end of the week, which was at 3,700 mark, and so we're getting the somewhat of a washout, just like they explained in their morning now. Thank you, folks, as always, for watching and listening. Be back hopefully sometime today with the economic update. If not, it'll be over the weekend. Take care. Bye-bye.